At its birth. The year was 1789. George Washington, a war hero, became the first president. Yet, the nation teetered on the brink of collapse. The Revolutionary War, though victorious, had left behind a mountain of debt. Paper money was worthless. States squabbled over unpaid dues. The scene was set for a financial crisis of epic proportions. The financial burdens were immense. The states collectively owed a staggering $25 million. The federal government's debt amounted to $54 million. This figure represented a colossal 40% of the nation's total economic output. Such a financial quagmire threatened to cripple the newly formed nation. The challenges were not merely internal. Foreign powers, sensing weakness, cast a predatory gaze upon the fledgling nation. Great Britain, still smarting from its defeat, refused to vacate forts in the Northwest Territory. Spain, meanwhile, controlled vital shipping routes on the Mississippi River. It was clear that without a robust financial system, the United States risked becoming subservient to foreign powers. The task ahead was monumental. The Founding Fathers had to find a way to repay the debts, stabilize the economy, and assert their sovereignty on the world stage. This was no small feat. The very survival of the United States hung in the balance. It was against this backdrop of uncertainty and peril that the story of American finance began to unfold. The fate of the young nation took a decisive turn one evening in June 1790. At a seemingly innocuous dinner party hosted by Thomas Jefferson, a historic compromise was struck. Present at the table were three towering figures: Alexander Hamilton, the ambitious Treasury Secretary; James Madison, the influential congressman from Virginia; and Jefferson himself, the Secretary of State. Hamilton, a staunch advocate for a strong central government, was deeply concerned about the nation's debt. He believed that assuming the state's debts would consolidate federal power and bolster the nation's creditworthiness. Madison, on the other hand, was wary of centralizing too much power in the federal government. He feared that it would weaken the autonomy of individual states. The dinner provided a platform for a critical negotiation. Hamilton, recognizing Madison's concerns, proposed a trade-off. In exchange for Madison's support for the federal government assuming the state's debts, Hamilton agreed to back the relocation of the nation's capital. The proposed site, a tract of land along the Potomac River, strategically positioned closer to Virginia, Madison's home state. This compromise, reached over plates of food and clinking glasses, proved to be a watershed moment. It paved the way for the passage of the Assumption Act and the Residence Act. The former authorized the federal government to absorb the state's debts, while the latter designated the area that would eventually become Washington, D.C. as the new capital. Thus, a seemingly simple dinner party set in motion a chain of events that would shape the financial and political landscape of the United States for centuries to come. Alexander Hamilton, the first Secretary of the Treasury, emerged as the principal architect of the nascent nation's financial system. A man of sharp intellect and unwavering ambition, Hamilton possessed a clear vision for transforming the fledgling nation into a global economic power. His blueprint for achieving this goal was outlined in a series of influential reports presented to Congress. In his first report, submitted in January 1790, Hamilton addressed the pressing issue of public credit. He argued that establishing the credit worthiness of the United States was paramount to securing loans and attracting foreign investment. To achieve this, he proposed that the government should honor all its debts, both foreign and domestic, at their full value. This, he argued, would demonstrate the nation's commitment to financial responsibility and instill confidence in investors. A year later, in December 1790, Hamilton presented his second report, this time focusing on the establishment of a national bank. He envisioned a central bank that would provide a stable currency, regulate private banks, and act as the government's fiscal agent. The bank, he argued, would facilitate trade, provide credit for businesses, and stimulate economic growth. Hamilton's final report, delivered in December 1791, addressed the development of American manufacturing. He believed that a diversified economy with a strong industrial base was essential for the nation's long-term prosperity and independence. To encourage the growth of manufacturing, he proposed protective tariffs, government subsidies, and investments in infrastructure projects. These reports, collectively, laid the foundation for a modern, market-oriented economy in the United States. The impact of Hamilton's financial policies was profound and far-reaching. The assumption of state debts consolidated federal power and established the creditworthiness of the United States. The creation of the first Bank of the United States provided a stable national currency and a framework for regulating the banking system. These measures, though controversial at the time, proved instrumental in fostering economic stability and growth. However, Hamilton's vision was not without its detractors. Thomas Jefferson, the leading voice of the Democratic-Republican Party, emerged as a staunch critic of Hamilton's policies. He viewed the concentration of power in the federal government with deep suspicion and feared that Hamilton's policies favored wealthy elites at the expense of ordinary citizens. The debate between Hamilton and Jefferson marked the beginning of a partisan divide in American politics that continues to this day. Federalists, aligned with Hamilton's vision, advocated for a strong central government, a national bank, and a diversified economy. Democratic Republicans, on the other hand, favored limited government, agrarian values, and states' rights. This fundamental disagreement over the role of government in society has shaped American political discourse ever since. Despite the controversies they engendered, Hamilton's financial policies laid the groundwork for the economic powerhouse that the United States would become. His emphasis on public credit, sound banking, and a diversified economy provided the foundation for centuries of economic growth and prosperity. The financial system he helped create enabled the United States to finance its expansion, weather numerous financial crises, and emerge as a global economic superpower. The story of American finance, therefore, is inextricably linked to the legacy of Alexander Hamilton, the visionary architect of the nation's financial foundations.